Members and guests. Members and guests, our keynote speaker today is Paul Brink, President and Chief Executive Officer of Franco-Nevada. Paul will have a conversation with Christy Batten. Christy is an award-winning journalist with 17 years of experience writing about mining. She's an Australian correspondent for Canada's mining.com, leads global gold sector coverage for the Denver Gold Group, and is a regular contributor to Stockhead and Resources Rising Stars in Australia. Please will you join me in welcoming Christy Batten to the stage. I would like to invite Andrew Hall, CEO of MMC Consultants, to introduce our guest speaker. Welcome, Andrew.
Thank you, Andrea, and good afternoon, members and guests. It's a pleasure to welcome Paul Brink to the Melbourne Mining Club. Paul hails from a mining family, with his father and grandfather having worked in the South African gold mines. He was born in a historic gold mining village in Gauteng, South Africa, and grew up in Johannesburg, studying mechanical engineering at the University of Witwatersrand. He was an avid student sportsman and rowed on the South African national team. The prospect of more rowing adventures ultimately attracting him to Oxford University. Paul met his wife, a Canadian rower in the women's blue boat, while completing his Masters of Philosophy in Management Studies at Oxford. His career started at UBS, working in project finance in both Zurich and New York. Paul joined the BMO Mining Group in Toronto in 1996, and he and Kate raised their 2 children in Toronto. Paul joined Newmont in 2006, working in the corporate development team. And when Newmont decided to sell the original Franco-Nevada royalty portfolio in late 2007, he joined the team that launched the IPO and the rebirth of Franco-Nevada. He led the business development efforts until 2018, when he was promoted to president and he took over the role of CEO in early 2020. Over the 18 years since the IPO, the company has produced 16% per annum compounded returns for its shareholders. Paul will take any opportunity to cycle in the summer, road, mountain or otherwise, and has adopted cross-country skiing to survive the Canadian winter. He is committed to supporting the education of disadvantaged youth and is a long-time supporter of Trails Youth Initiatives in Toronto. Please join me in warmly welcoming Paul Brink, President and CEO, Franco-Nevada, to the Melbourne Mining Club.
Welcome again, Paul. It's so nice to have you in Melbourne.
Oh, thank you, Christy. It's a delight being here. The last time I was in Melbourne was in 1992, so it's been a while.
I bet it's changed a little bit. Franco-Nevada's had 2 very successful previous iterations, and your predecessors, P. Ellisond and David Tarquil, have both spoken at this event. Can you recount the history for those people here in the room who don't know about the company?
Would love to. The Ellisond and Seymour Schulich were not the founders of the royalty business, but the founders of the public royalty business, and stumbled on buying a gold royalty, which was on Gold Strike, that was the success of the original Franco-Nevada. And on the back of that, Pierre and Seymour were both very astute investors, acquired a number of royalties that made Franco-Nevada was the 6th biggest mining equity by the late 90s. They're extremely colorful characters. Pierre, an extrovert, risk taker, famous for driving around in his Ferrari. They're a bit of an odd couple. Seymour was the opposite. He was and is conservative, older Jewish gentleman, always drove a beaten up Buick. but the two of them were great partners and made some tremendous mining investments. The second part of the story was Franco being involved in the merger with Normandy and Newmont, and there's a big Australian element in that. You'll all recall Robert de Crespigny consolidating Newmont, Normandy, Pos Gold, Kalgoorlie gold mines. But in the late 90s, Franco had again, by happenstance, discovered a gold mine, Midas, built the gold mine, didn't want to operate it, and had done a deal with Robert where they had vended the Midas mine into Normandy. They took back 20% of Normandy. Soon after that, AngloGold made a hostile bid for Normandy, and that was the catalyst that really brought together Newmont, Normandy, and Franco-Nevada. And so as you had heard, I joined the team during those Newmont days, and it was a couple of years later that the Franco business was spun out. But it really is, because of that history, a huge amount of the royalties that we own, a lot of the land that we cover is in Australia, and it comes from the properties that Normandy had accumulated. So actually, if you went strictly by the amount of land that we have an interest in, the name of our company should be Franco Western Australia, but it doesn't have quite the ring of Franco-Nevada, so we're sticking with Franco-Nevada. Anyway, we spun the business out, and it was 17 coming up by the end of this year. It'll be 18 years that we've had the second iteration of Franco-Nevada. It was really while we were part of Newmont that a new business was invented, and that being streaming. And it was Silver Wheaton at the time had written the first silver streams, and it was, at the time, it was frowned on. I mean, the conventional financing was debt and equity, and that's what everybody did. And the first streams that were done, people said, well, that's not really the way you want to be financing a mining company. But then they said, well, silver is not that valuable, so yeah, maybe somebody will sell their silver byproduct, but no one will sell their gold byproduct. Gold is far too valuable. Anyway, we came public, and the old Franco had a compound return for the 18 years they were public of 30% per annum. And so we said to ourselves, oh my God, how are we going to replicate that? And so we said, look, we'll keep at the old business, we'll buy gold royalties, but we're also going to adopt that silver streaming model, and we're going to apply it to the gold industry, and try and do gold streams. And at first, there was quite a bit of resistance against the idea, but it really has grown and grown, and it's been a tremendous run, and here we are today.
We'll come back to Australia a little bit later, but as you just mentioned, royalty and streaming financing has grown enormously, particularly in North America. What are the factors driving that growth?
Yeah, for royalty and stream financing, and as we said, for any CFO, they've got options in terms of how they finance their company, and there's always equity, there's always debt. Royalties and streams fall somewhere in between. If you compare it with equity, it's less dilutive for a company that's got multiple assets. If you sell a royalty in the stream, yes, that financier is sharing in the upside of that deposit, but it's just a single deposit. You're not sharing the upside of all the assets in your company as you do if you're issuing equity. If you compare it with debt, it's a more flexible way to finance. With debt, you've got a hard dollar burden. If your commodity price goes down, you're getting squeezed between the two. For a stream or a royalty, your obligation is only ever to deliver an ounce. So it's more flexible in terms of commodity price downside. And the second is, for a royalty and streamer, you're sharing in the production risk. For debt, if you have a production shortfall, you don't get any grace in your debt payments. For a royalty or stream, if you have a production shortfall, all you owe is a percentage of your production. So it just is a more flexible way to finance than in the debt market. So over time, what's happened is operators have found that is a good way to finance their business. And so I'd say the summary of it is, it's a model that over time operators have adopted and says this works well for us. I was looking at the stats over the last 6 years. There's $18 billion worth of royalty and streaming financing that's been done globally. So the industry goes from strength to strength.
So Australia has been less of an adopter to royalty and streaming financing. Why is that?
Yeah, a couple of things. I don't know the answer. This is why I assume it is the case. And the first is, royalties, equity, debt. They're all good financing tools. None of them is good or evil in its own right. For a CFO, the trick is you got to figure out when to use which one, what is the right time, what is the right amount. With equity, if you issue equity at the top of the market, it's fantastic. It's non-dilutive. If you issue equity when you're being squeezed at the bottom of the market, it's highly dilutive. With debt, if you do the right amount of debt and everything goes according to plan, it is the lowest cost of capital. But this is the mining industry. It's highly cyclical, and it's seldom that things go to plan. So sometimes when you have a downturn, if you've levered up with too much debt, the cost of it can be losing the whole company. With streaming, if you put too much of a burden on the asset, then the stream can impede the future development. So I think in Australia, there were some early instruments that are out there. I think some people had experience. The instrument was just too large. It did impede the asset. I think some of that early experience colored it. My view on it is, yes, with any instrument, some people may apply it in the wrong way. I think the industry has learnt a lot. Certainly when we're doing deals, we pay a lot of attention to make sure that we put a royalty or stream on, it's not too big a burden. So I'm often having that discussions with CEOs, with CFOs, and pointing out typical royalty is 1% to 2%. Typical stream, if you're financing a big part of the capital of a mine, it may start off at 8%. Usually there's a step down to, so maybe on average you've got about a 5% burden longer term. So it really is a win-win instrument. As an operator, in our business, we pay a fair price for what you see today in terms of that reserve and resource. That is a low rate of return to us. We only get a higher rate of return if that resource expands and becomes far larger. At 5% for the operator, you still own 95% of the resource. So if you find a whole lot more, it really is a win-win. I think the second element in Australia is there has been a preference for debt. And as I say, if you put too much debt on a company and things turn down, production turns down, prices turn down, it is less flexible. And so in some cases you can lose the company. But it can be worse than that, and in particular, often with debt, you get hedging. And so you can be in the crazy position where actually things go right, and commodity prices go up, and you lose the company. And, as in this last cycle, I think you've had quite a bit of that in Australia, that you've got companies like Calidus, like Red 5, like Bellevue, that have had huge blow-ups in their hedge books that have ultimately been a huge cost to investors because things haven't gone as planned. So I was thinking about this on the flight down, and I realized that the best analogy for streaming is golf pants. And you think, what am I speaking about? Well, yeah, in the old days, we all, men were men, and we all wore Levi jeans. That was the thing to do. The thing about Levi jeans is they're just not very flexible. So I was flying down. I went to Toronto, Vancouver, and Vancouver, Sydney, and Sydney, Melbourne. I had 24 hours on the plane, and I was sitting there thinking, thank God I'm not wearing Levi jeans. I got a pair of golf pants on. So streaming is the golf pants of mining finance. You can look good wearing them, and they're flexible. If you're sitting on a plane for 24 hours, they're flexible. If you're playing golf, they're flexible. If you're dancing, they're flexible. So streaming is the golf pants of mining finance.
I like that, and it's very important to wear comfortable pants on the plane. Yeah. Continuing to talk about Australia, you've just added to your team in Perth. I take it from that the plan is to grow in Australia.
Absolutely, and I do, for a long time, Kevin McGilligan, my colleague is here. Kevin, why don't you put your hand up? There he is. Kevin has run our operations out of Perth, and we've recently hired Matt Selby. Matt had a very successful career at Argonaut and now has joined our team. The reason that we're hiring is our plan is to focus more on Australia. And it's not so much about royalty and streaming and the opportunity that attracts us to Australia. It's more around operators. And there is a difference in the way the Canadian industry is run versus Australia. In Canada, I mean, we have a tremendous amount of mine developers, teams that explore, make discoveries, do feasibility studies. What we call them are promoters, and we celebrate promoters. But their intent is not to build the mines that they find. Their intent is to sell the mines to the senior operators. So it's hard to find, good teams. So we, a couple of years ago, had said, as an alternative strategy, rather than a lot of our business is participating in auctions, we said rather than just participating in auctions, let's find those players that are good mine developers, good operators, and people who really want to do it, and let's be a financial backer to those teams. We'll provide them royalty stream finance, but we'll also provide them debt if they need it. We'll provide them with a lead equity order if they need it. We want them to know, and we want the market to know that we are their financial backers. And we figured with that strategy, so much of the risk with a junior mining company is inevitably something goes wrong, and so often investors get horribly diluted when that is. So we thought if we can take the financial risk out of these players, we can really differentiate them from the other players in the field. We've done it twice. The first was with the G Mining Ventures. That's the team. Their business was G Mining Services. Many of you may know them. They're in the business of doing feasibility studies, but also in building mines. So they had built Merian for Newmont. They built Fruta del Norte for Lundin Gold. They built Essakane for IM Gold. So a super accomplished team. They wanted to start their own company, and we said we would back them. The mine they built is Tocantinzinho in Brazil. It's been a fantastic success, and they are a darling of the industry. The second one was Discovery Silver, Tony McCooch. Tony, also a longtime industry veteran. So we financed his team buying the Porcupine assets coming out of Newmont. And that deal, we did it the back end of last year. It closed in April. It's already been a blowout success. His stock is up somewhere between 400 and 500%. It's hard to keep track day to day. But those two companies, GMIN and Discovery Silver, are the top two performing junior gold companies in North America. We're very proud to have backed them. And that's the opportunity we see in Australia. Australia is very different. You have far more teams that actually want to build mines and want to operate mines. And so the opportunity we see here is we'd like to find the next team to back. Hopefully we can find a couple of teams in Australia that we can back and hopefully have a similar amount of success.
And of course, Tony McCooch is another former speaker here when he was at Kirkland Lake. Switching gears a little bit, Panama's decision to shut the Cobre Panama mine in 2023 was a bit of a shock to the industry. You're heavily involved in that asset. What caused such an anti-mining shift in the country, and is there any prospect of that mine sort of coming back online?
Yeah, first off, it was a surprise to us. It was a surprise to the government. It certainly was a surprise to the company at the time. The best way I can describe what happened is a bit of a Brexit moment in the country. The lead up to that was First Quantum, fantastic mine development team. Their technical folks out of Perth, I think, are some of the best in the industry. Had built Cobre Panama, super success. We're very proud to have been associated with it. But the government forced them into a renegotiation on the fiscal terms, really starting in 2018. It all got delayed by COVID. So it came to a head post-COVID in 2023. But the government at the time, the Cortizo government, Cortizo unfortunately was suffering from leukemia, so he had been a bit of an absentee president. made a lot of promises about social spending. That hadn't happened. COVID clampdowns had been quite severe. So you had a society that was already quite unhappy with the government. There had been protests even ahead of the mine shutdown. They were anti-government. So the pot was just boiling pretty hot in the country when the renegotiation happened. Unfortunately, the negotiation was done in public. The government had vilified the company quite a bit, really in an effort to twist their arm to get better terms out of them. Unfortunately, once they had cut a deal and they then returned to the public to get it approved through Parliament, they said, oh, this is a fantastic idea, and the public said, what the hell? Like, it was only 3 months ago you told us that these guys are villains. The protests broke out. The government panicked, and they shut the mine down and banned mining in the country. So there was a lot of passion at the time. Following the protests, at least 70% of people polled said no mining, we're done. But that really has changed over time. Now, folks are setting down. The economic rationale is setting in country. The mine is 5% of GDP. It's 75% of export earnings. It was 7,000 direct jobs. It's more than 50,000 indirect jobs. So the population is coming around. The polling is now more than 50% of the population say they're open to mining in some form. There's a new government, the Merino government, and Merino from the outset said he's open to a discussion. The first issue he had to deal with was pension reform, which is done. In March of this year, he said to his government, the next issue for us to address is the mine. He set a target. He said by year end, I'd like to have the issue of the mine sorted. Both the company, First Quantum, and ourselves initiated an arbitration. The government asked that we stop the clock on that so that they can negotiate. We'd agreed to do that. We said, provided you can meet our conditions, which was get the existing concentrate shipped, put your team together so that you're ready to negotiate, and they've met all those things. So the table is set, and the other part of it is an environmental audit. The government has said we want to do an audit. My view is so that once they have renegotiated a deal, they can come back to the public and say, we've got a better deal for the people of Panama. We've done environmental audit. The allegations of environmental damage are unfounded. There is a clean bill of health. So I think there's a good chance that Cobre Panama will come back online.
I think you recently said that if it does come back online, you'll be popping champagne corks.
Exactly.
Some of your other large assets are precious metal streams on copper mines. How were you able to secure those?
Yeah, so other than Cobre Panama, it obviously is a big copper mine, and we have a precious metal stream. Our next three biggest assets are the same. Candelaria with Lundin Gold, Antapaccay, which is run by Glencore in Peru, and then Antamina, that's a consortium of Glencore, Teck, and BHP, all amongst the world's top 20 copper mines. We have precious metal streams on them. The truth is, we never dreamt that we would have an interest in assets like that. We never dreamt that we would be financing companies like Teck and Glencore and really Freeport in the sale of Candelaria. But it really is a tale about financial flexibility. And, going back to the conversations with CFOs, so often the discussion is around, well, debt is cheaper than, they like debt, and it's cheaper than streaming, potentially. And often the discussion I'm having and the discussion we have internally in Franco is when you're financing, the cost of capital is one thing. It's actually not the important thing. The important thing is the financial flexibility that your capital structure gives you. And so 2015 is a tale of that playing out. At Franco, we use debt. We just believe there is a time to use debt. Don't hold debt through the cycle. Pay it back as quick as you can. Our view has always been the best opportunities in the market happen when there's a downturn. If you go into a downturn with a whole lot of debt, you're not able to do anything. So you're not able to seize those opportunities. So our view is minimize the use of debt. When there is a downturn, maximize your available capital, use debt in the downturn. That's exactly the time to use it to take advantage of the opportunities. So 2015, what happened? China slowed down. Copper prices came down, iron ore prices came down. All of the major diversified companies were caught offside with the amount of debt they had. You'll probably recall it was early 2016, Andrew Mackenzie, BHP had a progressive dividend policy, 15 years of increasing dividends. They had to cut the dividend. Glencore, Freeport, Teck were all offside on their debt. The rating agency said to them, you got to sell assets or we're going to downgrade you. So we did those 3 deals. Effectively, we financed Freeport by helping Lundin purchase Candelaria from them. We financed Glencore on the Antapaccay deal, and we financed Teck. We got some fantastic assets. We'll do very well with them. It actually also was exactly the right thing for those companies to do. In the couple of years following that, Teck's stock increased 8-fold. Glencore's stock increased 5-fold. So it created an opportunity for us. But the tale of the story really is about the importance of financial flexibility rather than just the cost of capital.
So you've recently alluded to as much as 50% growth in the next 5 years. Where is that growth coming from?
So the 2 pieces of that, we've got a good amount of growth built into our portfolio, and 2 themes. And the one is it's been a very active period in Canada building new gold mines, and we were fortunate to have an interest, royalties on a lot of those new mines. So we've seen the Greenstone mine get built. We recently bought a royalty on the Côté mine that's been built by IAMGOLD. We've got royalties on Valentine Lake, which is just completing construction now. The next mine to get built in Canada that's in process is Eskay Creek that we have royalties on. So we're participating in what has been a very active period in Canada, building new mines. The next set of mines to get built in our portfolio, a number of them are in the US. And we have been great beneficiaries of the Trump administration and the change that they've had on the emphasis on unlocking the permitting process in North America. So we have the next gold mine to get built in North America will be Stibnite Gold. It's Perpetua Resources. We have royalties on it. The next copper mine to get built is Copper World, which is Hudbay. Both of those permitting processes have been unlocked. Another smaller one, Castle Mountain in California. We have a royalty on that. And it has been put in a fast permitting process now, Fast 41. So those are the themes that are driving our 5-year growth.
So we obviously have to talk about the gold price hitting 6,000 Aussie and 4,000 US this week. What is driving the spectacular gains in gold so far this year?
Yeah, well, I'll rephrase it in these terms, in terms of what are the events that are causing the pivot in the gold price? Who are the people who are causing that pivot in the gold price? And immediately where your mind goes is de-dollarization, and the person who is pivotal in that obviously is Donald Trump. You couldn't have written a more perfect script if you'd wanted to, and how to undermine the US dollar. The first is the currency of international trade. These trade restrictions the US have is accelerating the shift of global trade to China having a greater share of it. The second thing you need to be the reserve currency is you need to have the best balance sheet in the world. The US is running a 7% structural deficit. That's the worst structural deficit of the G7. The US has now lost their AAA investment grade rating. And the third thing you need to be the reserve currency is unbreakable trust in the independence of your institutions. And Mr. Trump has undermined the bank. So he is pivotal in that. But that I would say is it's certainly what is driving this leg of the gold cycle. But I don't think it is the longer-term cause for the shift in the gold cycle. And the longer-term shift, which will be the enduring shift, is how central banks think about monetary policy and how central banks think about their own reserves. The pivotal point there was the financial crisis in 2008. And I was thinking through who is the pivotal person in all of that. And Monica Lewinsky is the person that comes to mind. So I'm going to have to play that backwards a bit to explain what I'm thinking about. So let's go back. The end of the link to gold with the dollar in the 70s. Then we had the oil crisis. Gold prices blew up. But central banks then started selling gold. Through the 80s, they were selling gold. Through the 90s, central banks accelerated those gold sales. That was the Clinton administration. You had Greenspan was managing the Fed. Clinton was actually the last US president to run a surplus. It was, some call it the Great Moderation. Some called it the Goldilocks economy at the time. It was not too hot, not too cold. It was the last time we had the US and many of the world's Western economies that were actually being well fiscally managed. In that environment, you didn't need gold. Central banks were selling gold, so much so that at the end of the 90s, the World Gold Council convinced the central banks to work together, and they entered into an agreement to limit the rate that they would sell gold. So the agreement was the central banks would only sell 400 tons of gold per year. So that slowed the sale of gold through the 2000s. And the turning point was then 2008, the financial crisis. If you look at any chart of when the central banks started adding gold, that was the point in time. And ever since then, it's been a straight line. It's been a straight line since 2008. That's 17 years ago it's been ongoing that central banks have been adding gold. So again, you ask, what has that got to do with Monica Lewinsky? So we got to play it back a bit. And you know, what happened in 2008 with the financial crisis? It was QE. As we went into that financial crisis, the European response to it was the old school response, which was austerity. The US response was QE, just providing liquidity. What played out is the US was successful. That managed to avert a big recession. And what Europe experienced is that ultimately there was not the political will to stick with austerity. And so ultimately austerity was disbanded. That was the turning point in the minds of central bankers. Because central bankers realized that the way forward in averting a crisis was to provide liquidity. And central banks also realized, what do they hold in their reserves? They hold the currency of other central bankers who have just had the same epiphany that the way forward is liquidity. And so it was the turning point in the minds of central bankers that the way governments respond to crisis will be liquidity, that there no longer is the political will in Western governments to balance their budgets and face austerity. Again, how does that relate to Monica Lewinsky? So I'll play it all back. So Clinton ran the economy. He did a fantastic job economically. As I say, he was the last US president to run surpluses. His unfortunate dalliance was with Monica. He didn't lose his job because of it, but it was the setup for the next election. So the next election was Al Gore. It was George Bush. It was on the back of the tech boom. So tech had been booming through the 2000s. But that election, you'll recall, was a tie. And the uncertainty that was created, because you had a month when nobody knew who was going to be the next US president, that was the straw that broke the back. The tech bubble burst. You had a huge downturn, and the net result of that was Alan Greenspan had to cut rates dramatically to avert a recession in the US. Those low rates, I mean, which industry is most highly levered to low rates? It's real estate. So that cut in rates in the early 2000s, that sowed the seeds for the US housing crisis, the subprime crisis. And the subprime crisis is what caused the financial crisis. And the financial crisis is what caused central bankers to have the epiphany that the way forward was QE. So if Monica Lewinsky had just kept quiet about her affair with President Clinton, then perhaps Al Gore would have won that election. the tech bubble wouldn't have burst. It would have been a soft landing. Greenspan wouldn't have cut rates. We wouldn't have had the subprime crisis. We wouldn't have the financial crisis. We wouldn't have had QE. And gold today would be $300 an ounce.
And just before we go to audience questions, what is your prediction for the gold price in the next 5 years?
As we know, nothing goes in a straight line. But go back to gold being linked to the US dollar. The link was $40 an ounce. Today we're at 4,000. Put that another way around, it means that the US dollar has lost 99% of its value against gold in that time. If you do that in terms of a CAGR, it means that the gold price has appreciated at 9% per annum against the US dollar over that period. So as you look forward over 5 years, the rational target is to say 9% per annum from 4,000. That takes us up to $6,000 gold US, $9,000 gold Australian. So that's the rational target. Now, obviously, there's an over-under. It could be higher, it could be lower, but that's the trajectory we should expect.
Nice. Well, I'm just going to invite Andrea back onto the stage to facilitate the Q&A. I think we've got roaming mics running around, so put your hand up if you've got a question for Paul.
Thank you, Paul, and thank you, Christy. Now to questions from the floor. If you're asking a question, please wait for the microphone and stand up so we can see you and state your name and affiliation. Any questions? Go on.
Paul, thank you for coming. William Morgan, Heritage Capital. Paul, you mentioned Trump's deregulatory agenda. I think there's 100 Fast 41 projects out there. But can you reflect a bit more on the benefits of his mining deregulatory agenda and which jurisdictions are benefiting most from it?
There are two elements to his agenda, and the first is deregulation across the board and unlocking mining permitting in the country. So as I pointed out, we already are beneficiaries in terms of what that is doing for U.S. mining. But perhaps it is a surprise, he remains focused on critical minerals and sourcing critical minerals. Now, one part of that is a surprise, the other part isn't. Prior to Trump, the U.S. thinking around critical minerals, a lot of that was around clean energy and minerals for clean energy. And under the Trump mandate, they speak about critical minerals, but it is really minerals that are critical for military applications. So there is a shift. Those metals, those minerals, particularly those that you need for the magnets that would go into so many defense applications, but other commodities, and we're beneficiaries with stibnite, antimony used in munitions. There is a real focus on all those commodities, and so countries that have those and countries that are allies, like Australia to the US, will be big beneficiaries. The surprise part of it is he actually has continued his mandate to support metals that are critical for the energy transition. And so you've just seen with lithium and the investment that has been made in Lithium Americas that he continues to do that. And so again, I think there's an opportunity for Australia there, being a very strong ally of the US, both in terms of metals that have military, but also clean energy applications.
We've got one over here.
Hi, Paul. Over here. Gavin Collery, founder of the Melbourne Mining Club and a few other things. Australia's biggest trading partner in our sector, of course, China. I was wondering if you could just give us your view as to the current influence and future influence you see of China on the global scene for our industry and our commodities.
In short, I think it can only grow. If you look at China and the amount of countries where China is the #1 trading partner, the total is 120. If you look at US and the amount of countries where the US is their #1 trading partner, it's 15. So already, China dominates global trade. The US tariffs will only accelerate that. So they will be continually important. Another thought that comes to mind in looking at this, and I was reading a book by a Swedish economist recently, just on world developments. He's a big picture thinker, but one of the pieces that had really struck me was he was simplifying world population and where it is today and where it's going to be. And roughly the world population is 8 billion people. Roughly 5 billion are in Asia. You've got another billion that is in the Europe and North America together, and another billion or so in Africa. Look out, in 30 years, the world population will be 12 billion, but 3 of the additions will be in Asia, 1 will be in Africa, and there's no growth in the Western world. So we'll have a population where you've got 1 billion in what we consider the Western world and 8 billion in Asia. So what is the locus of economic activity going to be in 30 years' time? The locus is going to be Asia. The centerpiece is going to be China. So it just is an economic reality, and I think for countries like Australia, certainly for countries like Canada, where it's a very big question right now with the trade issues we have with the US. Do we in Canada continue to just link ourselves completely to the US, or do we need to look elsewhere and diversify our trade relationships? I think the obvious answer for Canada is yes, we have to. For Australia, you already have. You, in fact, have an incredible advantage because of the position of your country relative to relative to Asia. So when I think of those demographics and the trends that are going wrong around the world, I think there is a huge, huge opportunity for Australia.
Hi, I'm Stephen Rowe from Dragon Tree, guest of Lowell. Thank you, Stephen. Thank you for the insightful comments. We're invested in commodities in different jurisdictions, from Mongolia to Alaska and Canada as well, Africa. But increasingly, I guess the role of gold has been put alongside Bitcoin, which is probably a controversial question to ask, but I'm sure as a leader of a company very exposed and pivotal in gold and its role of a store of value in central banks, with the fact that central banks themselves and the Trump administration's policy towards gold and its role, is not something you've publicly talked about that I can find in many areas, but I'd just welcome your thoughts from how you think about it. Is it relevant? Even if it's not for Franco-Nevada, I'm sure some of your LPs are being forced to ask the question, or at least say no to the question if they don't say yes. Sure.
It's been very interesting seeing the development of Bitcoin, blockchain, cryptocurrencies, and they've grown in popularity and are doing extremely well right now. People ask, is that going to cannibalize gold? Because of the nexus between the two, that both is a hedge against the decline of fiat currencies. And there is that nexus, but there is not much overlap in the use case for gold and for crypto and the investor demand. So what you found is gold is risk off. The holders of gold, the reason you hold gold is to hedge against market volatility, to hedge against those currency declines, but it is very much a risk-off investment. I mean, the way we think about our business is exactly that, is how can we provide a gold investment to people who want a risk-off investment and so minimize the risks. Bitcoin has proven being exactly the opposite. When you look at the trading and the trading statistics for Bitcoin, it is risk-on. So the biggest correlation of Bitcoin is to the NASDAQ, and Bitcoin is effectively a leverage play on the NASDAQ. When the NASDAQ is up, it's up even more. By definition, there is no asset to Bitcoin It is a momentum trade. It can only be a risk-on trade. And it's been a very successful risk-on trade. Is there space for both? Absolutely. Is there much overlap between the two instruments? I don't think so.
Okay, hello. Thanks a lot for your, discussion. I'm Lachlan. I am, a future leader of this industry, I've been told to say. I think your story about the mine shutdown in Panama was particularly interesting. So I'm curious to ask you, what steps do you think as our industry can take to potentially be more socially accepted or respected, and deal with people and the society better?
It's a good question, and being asked 1,000 times by investors, what did go wrong? What could the company have done better in country? First Quantum, I don't think did anything wrong, but could they have built a better social license in country? They could have. In particular, what happened in Cobre is that the mine build itself is quite remote from Panama City, the capital city in the country. When they were building the mine, it wasn't getting a lot of press within Panama City. So they took the approach to say, let's let sleeping dogs lie, and they had kept a low profile in country. They didn't anticipate, obviously, a public renegotiation that would happen. They didn't anticipate being vilified. Perhaps had they known that, they would have built more profile in country so that people better understood what mining was, better understood what the benefits of mining to the country were. As we delved through what had happened, there was a vacuum. So when things blew up, the general public didn't have a good understanding. It was very easy, and these days so easy through public media, for allegations of environmental damage. One of the interesting things that still, if you take a cab in Panama and you ask any cabbie, why everyone is against the mine, the typical answer you will hear is that the mine is stealing the water from the canal, and so that the mine is the reason that the Panama Canal is having to cut their traffic. What was happening at the time is there was a drought that was impacting Panama's traffic. None of it makes any sense, that the mine is 2 watersheds away from the Panama Canal. But it's, in a vacuum, that's the kind of information that gets spread around and that the man on the street will pick up and repeat. And so, what is the takeaway? Yes, the industry does need to be on the front foot. We tend to be shy. We're sometimes embarrassed about our industry. We don't speak about it enough. We don't speak about the benefits that our industry is creating enough. And so I think the message is the industry needs to be on the front foot. It is a fantastic industry in terms of contributing to global economic growth. It is a fantastic industry in creating good, well-paying jobs. And we should celebrate that. We should talk about that. And I think that the more broader the understanding there is of that, the better acceptance there'll be for mining.
Okay, that concludes our questions today. I would like to invite John Tiwi, the partner of White & Case, to deliver a vote of thanks.
Members and guests, first of all, a big thank you to Christy for all the work she did preparing for this. It's not an easy task. Looks easy from down there, but I know you do a lot of work and putting it together. Paul, thanks for your fabulous insights into Franco and its history, your discussions around royalty streaming and why it's so common in the US but not as common in Australia, but becoming more common. Your plans in Australia, your financial partner model was a really interesting model to hear about. It was really interesting to hear your insights into Cobre Panama. Great to hear about Franco's current assets and how you plan to grow. And also, of course, your insights into the factors driving the gold price and where it goes to from here. I think we all now have visions of boardrooms, senior executives of companies, when they're reviewing their balance sheets, they're all going to be putting on their golf pants before they make that decision about their mix of debt, equity, and other sources of finance. So thanks very much, Paul. I've got a gift for you here. Cheers.
Thank you, John.
Got a hold of that.
Thank you. All right.
I don't know how you get it home, but you know.
Well, look at that. That's fantastic. Yeah. Look, that's super. Christy?
Thank you.
Thank you.
Thank you.
Yeah.
Oh, yeah.
Come on in. Gotta get.